Welcome to Hargreaves Lansdown's Meet the Manager. I'm Joseph Hill, and today I'm joined by David Ennett, co-manager of the Artemis High Income Fund, which features on our wealth shortlist of funds selected for their performance potential. So David, in the Artemis High Income Fund, you aim to generate a high income for investors by focusing on high yield bonds. So how are high yield bonds different to investment grade bonds and government bonds, and why do they generally offer a higher yield?
Yes, that's right, Joe. So what this fund does is it invests about 50% of the fund into global high yield bonds. Now, as a fixed income investor, you can lend to governments or sovereigns, UK government, US government, for example, investment grade companies, which are those large multinational companies that we're all very familiar with, or those companies that are a little bit smaller and they're known as high yield companies. And they're companies, if we look at credit ratings, that are rated BB and below, whereas investment grade is single A down to BBB. Now, a lot of these companies are also global companies, predominantly denominated in the United States, but also in Western Europe, UK and Australia, countries like that. Now, the advantage, or what these securities give you, is they give you a much higher level of return. In addition to that, they also tend to be much shorter dated. So when you're lending to a government or an investment grade company, you're normally doing that for quite a long period of time. And whilst that has its advantages, in an environment where interest rates are quite volatile, where a lot of investors aren't sure about growth and inflation and the path of interest rates, that carries a very separate set of risks. What we're trying to do with a high yield bond is we lend to companies that are a little bit more risky, but we lend to them for a far shorter amount of time, 3, 4, maybe up to 5 years. And that allows us to sort of take less of that interest rate risk, which is often called duration risk in fixed income, but it's really just exposure to what's happening in interest rate markets. And we decide, no, we like to get our income lending to companies, and where we can do the work, we can analyse these companies and see how good their cash flows are, how good their business model is, and use that as a source of capital, use that as a source of return. And in the current environment, we're actually getting much higher yields doing that than you do in longer duration or longer interest rate exposed markets. And we think the opportunity set for this part of the market is very good at the moment.
And you mentioned interest rates there. We've seen quite the reset in yields in recent years. Rates have gone from their ultra low levels, and it does look like they've peaked now and are on their way down. But over that period, how has that affected companies? Have default rates risen over that period, and what does the opportunity set look like at the moment?
Yeah, absolutely. I mean, it's been interesting times in bond markets for the last few years, and you touched upon it there. As we came out of COVID, interest rates were very, very low as central banks around the world cut interest rates to try and support economies that were shut down or just emerging from shutdown. Where we are now, we're sort of dealing with the consequences of that a little bit. So we're seeing a lot of inflation and a lot of uncertainty about the ability for central banks and governments to get that inflation under control. Now, what we're seeing on the credit side, so within this part of the market, so 50% of the fund being in global high yield bonds, we are taking more of that default risk, and you touched upon it there. We have seen a slight uptick in defaults, but much, much lower than people, I think, thought would happen given the sort of what's happened in the global economy. And there's a few reasons for this. The first one is what we call the seasoning effect. So if we go back to the COVID period, which is remarkably 5 years ago now, it feels like it was only 12 months ago. But what that did is clearly a huge ruction for the global economy, and that really shook the tree. And a lot of companies that were exposed to COVID, some weaker airlines, etc., of course they defaulted. But also a lot of otherwise just generally weaker companies, they also defaulted because credit conditions were very tough and the economy was shut down. And it kind of shook the tree is the analogy we use. What we see in global high yield is in the years after a big default episode like that, you get what's known as abnormally low defaults. So people sort of say, well, given the level of growth and what's going on, we would expect more defaults, and we absolutely would expect more defaults. But where investors can benefit is, it's a survivorship bias issue, and companies today that are active in the high yield markets, they've survived COVID, a shutdown, inflationary spike, interest rate reset, and they're there. In addition to that, whilst we sort of call all of this part of the market high yield, there's actually a huge variety of companies in high yield. So the very top of high yield, BB bonds, and for this strategy, the bulk of our exposure to high yield is BB and single B bonds. We don't really invest in triple Cs here, but just for so you can sort of see how different this asset class is. A double B bond has about a 0.6% default rate in 12 months. That's very low and very similar to what you see in investment grade. Whereas if we go all the way down to triple C, which again, we don't invest in this strategy, that default rate is 26%. So I think when a lot of people think of high yield, their mind is automatically drawn to what's going on in triple Cs, and we understand that. It's much more exciting than what's happening at Virgin Media or some other double Bs that we know of. But really, the core of the opportunity here is in those double B and single B rated bonds that are perfectly good cash flow generating companies. And whilst defaults have picked up, disproportionately they're in that triple C part. And what we do is we're very active managers, and we focus on those sectors and companies in that double B and single B piece. And I think one of the other interesting things we're seeing is where those defaults are happening. Traditionally in high yield, when we'd have a default spike, it'd be in cyclical companies, exposed to the ups and downs of the global economy, or retailers, areas you'd probably think might come under some stress. What we've seen in this cycle is the trouble's really in what used to be, when I started in high yield sort of 20 years ago, were considered the safest sectors: healthcare, telecommunications. That's actually where all the trouble is this time, and these happen to be two sectors we've been long very cautious upon. And the reason is that they gorged themselves on debt during the quantitative easing period, and now that rates have gone up, they're having to deal with that, and that funding costs have gone up, and it's really stressed them. Whereas a lot of those cyclicals who sort of learnt the lesson in 2007 and 8, 9, survived COVID and have spent the last 5 years reducing debt, increasing cash flows, and everyone's sitting there going, gosh, why aren't we seeing the defaults? And it's really because a lot of these companies have learnt their lesson, and I think that's why the outlook for defaults is actually much more benign than people might think.
Something your analysis has identified, and something you've been speaking to your investors in the fund about recently, is the tendency of companies to call their high yield bonds early, so before they're due to repay the holders. So why would a company repay the owner of the bond early, and what impact can that have on returns for you as a holder?
Yeah, so for us, this is one of the really interesting parts of high yield. So there's a couple of things to say here. So again, if I look at a government or an investment grade corporate, Tesco, Nestle, a company like that, when they borrow money today and it's due in 7, 10 years, that's the end of it. They will repay it at the end of that period, not before, not after. And no one really worries about that. No one's sitting here going, gosh, I wonder if Nestle can repay that bond that's due next Thursday. Of course they can. They have ample liquidity, etc. High yield is a little bit different. A lot of our companies that we're investing in, the high yield bond or bonds that they have in their capital stack, so looking at the debt and equity that are funding a business, they're a meaningful part of those companies. So when you're managing a company like that, what you don't want to happen is to sort of say, okay, well, we've issued a bond today, it's due in 5 years, but we don't want to be a hostage to fortune of what the market looks like in 5 years from today, because of course we don't know. So what they do is give themselves a little bit of runway, so 1, 2, up to 3 years before that maturity date, and they say to the market when they're issuing these bonds, listen, yes, that's the maturity date, but we also will possibly repay the bond earlier, sometimes at a premium, so you borrow at 100p in the pound, and often the first opportunity to call or repay that bond is at a premium, so 103, 104 cents, but down to the par price. Now, why would they do that? Now, what we see in high yield is, if we go back through history, in fact, the vast majority of high yield bonds are called well before that maturity date, on average about 1.5 years. Now, why would they do that? So the first reason is, you can imagine this could be kind of a self-reinforcing cycle. If the whole market, people like me and my team, were looking at a company and one of the big risks they face is the ability to refinance a bond. Now, if they leave it to the last minute, obviously everybody's just watching them, and ironically, their ability to refinance might be impaired, i.e. everyone's worrying about it as they approach that date. So what they do is, hey, listen, we don't want that to be a problem. There's plenty of other problems they have to deal with day to day in their life, their corporate life. So they will call it early. Now, why that matters for us? The average high yield bond at the moment is priced below par. So that is, around about 93, 94 cents in the dollar. Why that makes a difference is because these companies are still going to repay that bond early, because the reason they're repaying it has got nothing to do with interest rates. It's got nothing to do with the rate at which they can reissue debt. In fact, we had some examples at the end of last year of very good tier 1 auto supply companies repaying bonds that they were paying 2.5% interest on, and replacing it with bonds they were paying sort of 6.5%, 7% interest on. Now that seems mad. None of us would ever phone up a bank and say, we want to break our fixed rate mortgage at 2.5% to go and pay 5%. But these companies have got different things they need to worry about. And they just did not want to be in a position where the market would even think about, you know, their ability to refinance. But that's really good for us, because what that does is if you're buying something below par, and as I said, most of the market is below par, and you get paid back at par or 100 early, that's actually additional return. Now, it's hidden return too, because when any of us talk about the yield on a fund, we're not allowed to talk about, oh, well, we expect that bond to be repaid early, even though we're very, very confident it will be. And so that's a source of hidden return. Now, something interesting, and there's, you know, been plenty of research done on this. People, you know, we get asked about defaults all the time, and people are right to ask about that, and you know, because it is the dominant risk we take. But what history shows us is the amount of default loss you get investing in high yield, which is very modest, and you know, you do get overcompensated for the risk you take in high yield. Around half of that is returned to you by this early call premium, which again is kind of hidden. So you can think of like defaults as being a hidden negative future return. Actually, these early repayments are a hidden sort of, think of it as a positive default. It's like a surprise sort of upside. And so that's why I think a lot of people, when they look at high yield, and you know, it is the best performing part of the fixed income universe, you know, historically, sort of scratch their head a little bit and go, well, hang on, there's the starting yield, there's the defaults, how come your returns are a little bit higher than that? And then when you layer on top of that the ability to act and invest actively and, you know, avoid more than your fair share of defaults, which we do, look for other bits of sort of upside surprise, you can see that, you know, it's an asset class that if you manage it actively has great return potential.
One aspect of your approach to running this fund that's unusual is its equity allocation, and through time that's tended to be around 15-16% or so. That's quite unusual among your strategic bond peer group. So why have that allocation, and what does it offer you in the context of the full portfolio? Yeah,
it is a really interesting part of this fund, and I think as an industry, one thing we're a little bit guilty of is looking at financial markets, saying that's how financial markets work, packaging it up and going out to people and saying, right, well, this is how we see the world, so this is how you should see the world and how you should divide up your investment approach. Whereas with this strategy is very clear what we want to do, which is produce income. Now, fixed income bonds that's what, you know, its day job is. That it's very good at that. But of course, equities can do that as well. And you know, having that 15% equity component within the fund gives us a couple of things. The first it does is it gives us the ability to sort of grow, some capital growth into the fund. So Ed and Ambrose, my UK equity colleagues who manage that part of the portfolio, they're looking for stocks that pay some dividend yield, and you know, much like bonds have their income component. There is that income component, but really what we're looking for in that is also the ability to sort of grow that dividend or income stream. So it gives us a little bit of a growth kicker in there. And I think from a sort of day-to-day fund management part, and actually me, running the strategy that I find really valuable, and it helps run, lots of different funds, is the way we can sort of look across capital structure. So for instance, if we're looking at sectors, say as home builders or banks here in the UK, we can get really great perspectives of, okay, well, how do we want to get income from a UK bank? Do we want dividends? Do we want senior bonds? Do we want more junior bonds? There's lots of different areas we can look in. And what this does is it allows us to, rather than say, okay, well, we're in bonds, so we have to look for bonds, or an equity fund that can only look at sort of different dividends, we can look across the capital structure and say, actually at the moment, and this is our view, we think actually UK dividend income is very much underappreciated, and the scope for growth there, the capacity to pay much higher levels of dividends in UK financials is already there, and I think we're just waiting for that tap to be turned on, because of course they're a little bit cautious and the regulator has been restraining them a little bit. But so we get that sort of cross capital structure view of the world, which is hugely beneficial to everything we do, but also I think from an income point of view, and we're kind of unabashed at this. We believe that the people who invest in this fund want income, and that's what we spend our day getting, and be it in bond market, investment grade, high yield bonds or equity income, there's lots of different ways to skin that cat.
And reflecting on your career investing in high yield bonds so far, what top investment tip have you learned along the way that would have been useful to know at the start, perhaps?
For me, it's things are never as bad or as good as you might think. I think some of the formative experiences of my career around financial crisis, things like that, COVID more recently, Eurozone crisis, all these sorts of things that I've been lucky enough to be investing money in during. Markets will often swing towards extreme pessimism and optimism as well. And I think not getting carried away either direction works pretty well. I also think from a sort of a day-to-day career thing is there's nothing more important than the people you surround yourself with and the teams that you build or go on or join earlier on in your career. And I think that has more, something I look back on over time, that has more kind of compounding impact on where you end up than pretty much anything else.
And who would you say has had the biggest impact on you as an investor?
I mean, it pains me somewhat to say this because I still work with one of the people involved, but I think that the formative experience of my career was as a young sort of fund manager, portfolio manager, as a credit crisis was kicking off in 2008-9. The team I was working with, so Steve Snowden, who I work with now, Chris Palmer, Richard Stevens, these guys, seeing how they reacted to pretty horrendous, biblically bad events that were happening around Lehman Brothers, all these sorts of things, but then sort of digesting that very quickly and then, buying risk in the beginning of 2009 and sort of seeing how that went. And it, it is such a cliche about, buying when there's blood in the streets and all this sort of things. But I think that seeing it firsthand when it is not easy, when every part of your, what makes you a human being, your biology tells you avoid pain. This has been painful, don't walk towards it. You have to sort of fight that a little bit and seeing that, I think, has had more impact on me than anything else.
And outside of work, how do you switch off?
Well, I've got young kids, so I drive them around a lot, or I support my terrible rugby league team that I support. And I think, going for a really bad sporting team is actually a good thing for a fund manager. I think microdosing that disappointment is very useful, and I would be very suspicious of fund managers who go for successful sporting teams. And given my colleagues' support, Norwich City, Plymouth Argyle, I think we're good to go there.
You can reveal the team?
The Canberra Raiders, if anyone's into their NRL in Australia.
David, thank you very much for joining us.
Thanks, Joe.